Welcome to Beyond by Wings, the business side of dentistry, brought to you by Edwards & Associates PC. Join us as we discuss how to build your dental practice, optimize your income, and plan for your future. This podcast is distributed with the understanding that Edwards & Associates PC is not rendering legal, accounting, or professional advice. Listeners should consult with their business advisors before acting on any of the information that is shared. At Edwards & Associates PC, our business is the business of dentistry. For help or more information, visit our website at eandassociates.com. Hello and welcome to another episode of Beyond by Wings. In today's episode, we are yet again going to be talking about the dreaded ERC, which is the Employee Retention Credit for those of you out there that are still not aware of what it is. And to talk more about the subject matter, we have a returning guest, Lynne Ledbetter.
Hey, I'm back.
Hi, I'm super excited to have you back on our new episode on ERC.
Yes, I don't know how many times I've been here talking about ERC. Maybe 3 now. Mm-hmm. Maybe this will be the last one. I hope so.
You know, it's funny you should mention that because we actually said that in the last episode that this would be the last episode.
That makes me cringe.
ERC. And here we are again, doing an episode on it.
Yeah, so update, ERC update. That's what this is about.
Correct, yes.
Okay, I'm just going to jump right into it. So, I hate to say I told you so, but I told you that you aren't eligible for these things. But seriously, the eligibility criteria for ERC was very specific. Mm-hmm. And these ERC mills were set up and then it kept loosening and interpreting, quote, interpreting the rules, and made it to where basically if you had employees and warm bodies in your office, you could, according to them, apply for the ERC and just get thousands and tens of thousands and hundreds of thousands of dollars. And that's what has happened. And it is being determined now. These cases are finally going through the courts and are being determined not to be eligible, as we suspected they were not. It's just that the IRS was too slow to catch up with the fraud. Right. And so we've been warning clients, taxpayers, whoever will listen for years now that this is not according to the rules, that this is fraudulent, and if you're caught, there's going to be repercussions. You're going to have to, best case, pay it back with penalties and interest and lose the fees that you've paid to the ERC people and all of this sort of thing. There's the risk that you have to amend your personal return and pay that tax. Right. There's the risk that you won't get that tax back because the time period's too long. So all of these things, we were saying, this is a danger. You need to watch out for this danger. So that's what's going on now. The IRS in September of 23 put a moratorium on paying out ERC credits. And so if you have anything in the pipeline, it is not moving, and it's still not moving. The last update that I heard was about maybe last week of January, that they still have not started processing the ones that have come in new. And the ones that they are looking at, they're going through in such minute detail to make sure that they're valid. It's taking just eons of time to go through each one and decide if it's valid or not valid and pay it out. So we're looking at a long, long time before these get processed and paid, if at all. If you're lucky, they'll just say, oh, it's not valid, and they won't give you the money. Otherwise, you're going to be subject to criminal prosecution. They've started prosecuting these. Most of the ones they've prosecuted have been subjected to fines and jail time. And so their criminal enforcement division, that's all they're working right now. So
highlighting on the word criminal.
Yes, criminal. Yeah, it's criminal. It's a criminal investigation. And so right now only 18 have gone to trial, but these are giant cases, $2.95 billion in total of the cases. But of the 18 that have been tried, 11 have resulted in conviction. So that's a high conviction rate. And about 24 months jail sentence has been associated with those. And of course, it's not the mills, the ERC mills, that are being tried. It's the taxpayer. Now, they will be going after the mills also when they can, but they're going to close shop and be gone. And that was also part of the warning that us and responsible CPAs across the country have been saying. The ERC mills are going to be gone once this dries up, and you are going to be left high and dry to fight this on your own, and that's what we're seeing.
Yes, and our playlist can attest to that. You
Thank
guys
you.
can go back to
Thank
our
you.
earlier episodes to see that on and on again, we've been trying to let our listeners
Yeah.
and our clients know about this.
Now, will the smaller ones be caught and scrutinized to that much of a degree? I don't know, because they've only got so many resources. So they may focus just on the really large ones. But I don't know what they consider really large. I mean, we've seen taxpayers across the country get $100,000 that they weren't entitled to. That sounds large. I don't know what their threshold is going to be.
right.
But there are also some that are very valid credits that we filed many for our clients that were valid, as well as non-clients that would call us and ask us for help with those. And so there are some valid ones. If your claim was valid, I don't want you to be afraid that that's easily proven. But you had to meet a couple of requirements, which one was a governmental closure. That had to be a governmental order, not a suggestion. It couldn't be OSHA recommending it. It couldn't be the dental board recommending it. It couldn't be even CDC recommending it. It had to be, it could be a local governmental order. So, like, for instance, us, Dallas County, had a requirement to shut down for a while. Didn't apply to us because we were considered
Essential workers.
essential. Yes, essential. I couldn't think of the magic word, essential workers. Well, unfortunately, so were medical workers. So that pretty much eliminates the dentists right there and all the doctors and things like that. Now, they were shut down for elective procedures.
Correct.
So non-emergency procedures, not essential procedures. So there was in Texas that the governor shut down for a while. Places like Dallas County, other counties shut down for a while. There were other states that had shutdowns as well, but you had to have an order from the governor or from a local authority to mandate that. It couldn't be a recommendation. So shockingly, even places like California, New York, even though they were much more strict about staying in and sheltering at home, they were not mandated to shut down. Those do not qualify for closures. So that's what people are surprised about. Oh, no, I had to stay at home. No, unfortunately, it was just a recommendation, and that doesn't count. Should it count? Yes, it should, but it doesn't. And then the other reason was if you had a reduction in business of a certain percentage,
Correct.
and that percentage varied, so I'm not going to go into what that was, but that was the other reason that was valid. And there were many companies around the states that did have that decline, and so they were eligible. But what these mills were doing was using things like supply chain. I had a supply chain issue, and yeah, that meets the qualifications. Well, no, it doesn't, unless that supply chain was subjected to a government order. So you've got to go find your supplier, get them to show you the government order that shut them down, that couldn't get you your supplies. Yeah, you're not gonna find that. So they have given some red flags to watch out for. If you filed under some of these premises, then you are probably in an ineligibility situation, and you might need to be concerned. One of those is too many quarters being claimed, like every quarter that ERC was available. If you're claiming for every quarter, that's generally that's not the norm when you apply the actual rules, so that's a red flag. Using government orders that don't qualify, like OSHA or CDC, that doesn't qualify. Too many employees and using every dollar that those employees made. So if you recall, there was also PPP loans going on at the same time, and PPP covered some of those wages. Well, those wages are not eligible for ERC. So if you're using all of your employee wages, you're probably using too many wages. And that's where it got complex, and where the mills were not checking with the accountants to see what wages they used for PPP. So we were very surprised when these companies were just, here's your credit number. Wait, you didn't even ask us what wages we use, so because you can't have those pieces. And we knew that was a red flag. Using supply chain issues, that's not allowed in most cases. And then the others pretty much don't apply to our clients, because our clients are good and ethical. And those would be if you didn't have any employees, if you're claiming an ERC and you didn't have any employees that quarter.
What are you saying? You're saying ERC, which stands for Employee Retention Credit.
Yes. If you're not an employer, you do not get a credit. If you weren't in business at all, just making up numbers, of course, you don't qualify. Yeah. So those things, I'm not concerned about those, but supply chain issue is the big one. So the IRS has given a sort of a voluntary a credit that you were not eligible for. Then you can return that, and you get to return it at a discount. So if you return that by March
31st.
22nd. I thought it was the 31st also. I just looked it up today. By March 22nd of 2024, then you only have to return 80%. And the reason that they're doing that is because they realize it's not the taxpayers really that fell for these big promises of the ERC mills, and they didn't understand the rules. And so what was happening is, anywhere from 15 to 30 to even 35% of the credit was going straight to the ERC mill, where a reputable company would charge you a fee for that work, not a percentage of collections. That's just obviously rife with fraud. So anyway, the IRS is saying, okay, you know what? We don't really blame you. We understand why you thought you were eligible, and we're not going to penalize you to be out this money. So just give us back the 80%. You can keep the 20%, which basically covers the fee that the ERC mill charged you, and we'll call it even, and we'll call you good, and there won't be any penalties. We'll all walk away happy. But that ends, and after that time period, you have to manually undo the filings. You have to file amended 941s. Most people won't go to that trouble. They'll just wait to see if the IRS finds it. And if they do, you're going to be subject to higher penalties and things like that. Probably not jail time, but it depends on what the circumstances were around that fraudulent claim.
Yeah.
I suspect.
That's right.
So.
Yeah. I was happy to hear that they said that just give us back about 80%.
Yeah.
Because I always wondered that. I'm like, these mills are charging, as you said, up to 35%.
Yeah.
And how is it fair for the clients that are like, we didn't know any better. Like, we tried to do everything by the book.
Right.
This was a dedicated company that apparently specializes in this.
Right.
How was I to know that?
And they ultimately, when the client signed off on that credit, it says you're taking responsibility. You're telling me that your wages are eligible. This is all on you and not us. But when they're giving their sales pitch, we know what we're doing. We've researched these rules. The supply chain issues do apply. Just trust me. So they were believing that because they considered them a trusted advisor, but they were only looking at the revenue that they could generate from those credits.
Absolutely. And even their pitch was so salesy. It was like $26,000 per employee, up to $26,000 per employee. You have 10. Okay, that's about potentially $260,000 you can get.
Yeah.
Wow. I mean, and can you imagine, going through COVID itself, going through, high turnover rates, increased expenses, they're having to buy additional equipment, PPE, it's just.
It's enticing because it's helpful. I understand all that.
Right.
So it was unfortunate, and I am happy that the IRS recognized that and is sort of giving them a little break there, because if you see that you did this and you're willing to just let's make it right, then they're giving them a break. That's really not IRS style. So I was really happy that they're showing a little compassion and grace, but it's for a very limited time. Limited time only.
Yes. And again, that's March.
Yeah, March 22nd.
Of 2024.
Yes.
Okay, so not too far away.
Not too far away, and maybe very close to this drop date.
That's right.
So, but we've been spreading the word, so hopefully you've already heard about it.
All right. Well, thank you so much for sharing all that ERC information all over again with our listeners. And I'm not going to jinx it. I'm not going to say it. Okay. I'm just going to leave it here and not say this is going to be the last episode. Just, thank you for being here and sharing all that information. Till next time, take care.
Thank you. Bye.
Bye. Thanks for listening today. Be sure to subscribe to Beyond by Wings on your favorite podcast platform. For more information, you can follow us on Facebook, Twitter, and LinkedIn, or reach out to us on our website. You can also shoot us an email at info@eandassociates.com.